Hello and welcome to this video all about cash flow. We're going to be doing some critical things that you need to know as a business student. First of all, we're going to be taking a look at what a cash flow forecast is and how we do the calculations. Then we're going to be taking a look at how we use these cash flow forecasts to identify any problems. And then finally, always my favorite thing, we're going to be taking a look at evaluating cash flow forecasts, which includes looking at the advantages and the disadvantages of using them. Let's get into it. So the first thing that we need to do now as part of this video is to understand what cash flow forecasts are. But to do that, we need to know what we actually mean by cash flow. Now, what cash flow is the movement of money coming into the business and going out of the business over a specific period of time. And you've heard this statement before, cash is king or queen, because it is crucial for a business's survival. We need cash in order to pay our expenses, such as our suppliers on time, our employees on time, and so much more. So in order for a business to survive and operate effectively, we need to have a healthy cash flow. And to help ensure we have a healthy cash flow, we have these things called cash flow forecasts. And all a cash flow forecast is trying to do is try to predict what the future cash flow of the business will be like. Now, one of the key reasons we want to do this is to try and identify any potential problems before they happen, so we can begin to think proactively. And as well, if the business is looking to try and apply for funding, maybe getting a bank loan, maybe looking at raising some share capital, they would have to try and produce this cash flow forecast, first of all, to identify how much cash they need and to present this to the people who are giving them the funding. And this is what a cash flow forecast could look like. So what we're saying is we're in the month of December and we want to try and forecast that future cash flow in January, February, March, and in April. So there's a couple things that I want to draw your attention to. First of all, we've got all the cash inflow. Cash inflow is the money once again coming into the business. This can be done in a variety of different ways. We could look at revenue from the sales that we've made. We can look at loans that we've received. We can look at investment income, and we can look at any other different source of finance. So for example, with share capital. So any cash entering the business, that will be classed as our cash inflow. Then we've got the cash outflows. That will be all the money flowing out of the business. And our cash outflows will include some of our expenses, such as our salaries, our raw materials, the rent we've got to pay, our utilities, payments to suppliers, and any other costs that the business has to pay. Now remember, just because we have a cost of the business doesn't mean we've paid that cost yet. We only record it as a cash outflow as soon as we've paid, as soon as we've transferred that money. Now there's a couple key calculations that we need to know. First of all will be our net cash flow. The way we calculate this, really simple. You take your cash inflow total minus your total cash outflows. So you can see here our total cash inflow is £1 million. Our total cash outflow is £200,000. So our net cash flow in January is £800,000. Then we need to do the opening balance. The way you do your opening balance is really simple. It's just the closing balance of the month before. So our closing balance that you can see in January is £800,000. So our opening balance in February is £800,000. And we just continue that on. The opening balance in March is the closing balance in February, so £650,000. And the opening balance in April is the closing balance in March, which is £600,000. The last thing that we need to do, the last calculation, is our closing balance. Another really simple calculation. All you do for this is that you take your net cash flow and you add that with your opening balance. So as you can see here, our net cash flow in January, as we calculated, is £800,000. The opening balance is zero. So really simple, our closing balance is £800,000. The next thing that we need to do now in this video is how we start to use these cash flow forecasts to try and identify any problems with them. Now, when we tend to see cash flow problems start to occur is that your cash outflows begin to exceed your cash inflows. And what that ends up in resulting is a negative net cash flow. So you've got more money flowing out of the business that is coming into the business. The primary reason, as we said, why businesses tend to fail is because they run out of cash. They can't pay any of their financial obligations. They can't pay their expenses on time. They can't pay their debt on time and end up having to file for bankruptcy. So what are then some of the main causes of why a business might see cash flow problems? Well, several different things that we can look at. And this just depends on the situation and on the business. First of all, you may see businesses who have seasonal demand. So for example, summer holiday homes, they will see a lot more demand in the summer, shockingly, than they will in the winter. But in the winter, they still have to pay those expenses. They still have debts to potentially pay. So those lower sales during the off season can cause those cash flow problems. You also may see just lower sales in general for a variety of different reasons. This could be due to a poor economic climate. We could be in a recession. There could be a change in the trends within the market. We could see different technological advancements, which leaves your business a little bit obsolete. Delayed customer payments is also a big one. So when you have higher receivable days. Now, what we mean by this is, let's say I've sold you the product as a business, but you said to me, Jack, give me 60 days and I'll give you all the money. I'm like, cool, that's absolutely no worries. Problem is, I don't receive that money now for another 60 days. I might need that cash to pay off some expenses that is due within 30 days. So those delayed customer payments can be quite of a problem. You also may have low trade credit agreement with your suppliers. So for example, your suppliers may sell you the raw materials, but want the money potentially immediately or within the next 30 days. Now, as a business, I want to try and delay that payment as much as possible. And the reason why I want to delay that payment as much as possible is because I want to receive the raw materials. I want to use them to make my product, sell that to my customers to then get cash into the business. And then that cash is used to pay those suppliers. But if you have low trade payable days, this is what can cause cash flow problems. There could also be any unexpected expenses. So for example, machinery and equipment breaks down and you need to repair them. And as well, any excessive or overspending. You may have spent a little bit too much money on a marketing campaign that didn't have the results that you would wanted. And finally, any poor financial planning or forecasting. Maybe you don't even create a forecast. How can a business then look at overcoming these cash flow problems? Well, identifying them as soon as possible is obviously the key for this. But you can start to overcome this by finding a way to get cash into the business quicker than it's going out. So you need to look at managing those trade receivable days and those trade payable days. Receivable days, how long it takes for your customers to pay you. Trade payable days, how long it takes you to pay your creditors. Another really simple way is to increase the amount of cash coming into the business. One way you could look at that is increasing the amount of revenue. Of course, the problem that we have there is that you may spend more money on marketing and advertisement to increase your sales. So even though, yes, cash inflow is going up, you may have to increase your cash outflows. Or you can look at different sources of finance. So look at a bank loan, which may actually impact you negatively in the long term. You could look at share capital and a lot more. And as we said, you want money coming into the business quicker than it's going out. So you want your trade receivable days to be a lot shorter than your trade payable days. And yes, as we said, you could look at increasing your cash inflows, but could you also reduce your cash outflows? So look at cutting some expenses. Now we know there is a potential issue with some of this. So for example, if you make staff redundant, that potentially reduces the amount of capacity that you can deal with. Yes, you can also look at cheaper supplies, but is your product quality going to reduce? And actually, will that then have a negative impact on your cash inflows? Just a quick one. If you are looking for a little bit more help with your exam technique, whether that's how you build your chains of analysis, how you correctly apply your answers, how to develop your evaluation, well, I've got a free exam technique course that goes through everything that you need to know. I've even included some model answers so you know exactly how to get the top marks. As I've said, this is completely free and you can sign up by using some of the links below in the description. Back to the video. And the final thing that we need to do now in this cash flow lesson is evaluating those cash flow forecasts, looking at the advantages and the disadvantages of using them. The first main advantage, as we've been saying throughout this session, it helps us identify any potential cash flows in advance. Let me show you an example of this. Say here, I've got a cash flow forecast. Once again, we're in December and I've forecasted January, February, March and April. Well, some things that I can already begin to identify. Well, first of all, looking at March, the problem that we have is that my cash inflow total is £200,000, but my cash outflow total is £800,000. And that has resulted in a negative net cash flow of £600,000. And because of that negative net cash flow of £600,000, my closing balance in March is now negative £150,000. And that's a big problem. But what's good about the cash flow forecast is that I've already identified this. I need to now find a way of how can we prevent that from happening? Could we look at reducing those expenses? Could we look at also increasing our cash inflow maybe in February or March by looking at external sources of finance? Also as well, it reduces the risk, as we've said, of the business running out of cash. Cash is king. We need cash to survive. And it also helps us with our decision making because we could be looking at trying to launch a brand new product or go into a brand new market. Well, the cash flow forecast might say you don't have enough money for either of those. If you want to, you're going to have to look for additional funding. And that helps us with that planning phase. And of course, the big thing is that it helps improve our management of our cash inflows and cash outflows, and it will support the business when trying to secure funding, and it will even identify whether we do need to secure funding in the first place. Now that sounds all brilliant and all really good, but there are certain problems when it comes to the cash flow forecasts. Now remember, it's called a cash flow forecast. It's in the name. It's a forecast, meaning that we are only predicting and estimating what might happen. There is no way that I can 100% guarantee that it will end up like this. And the reason why is because we've got the external environment to contend with. We know there's events that could happen that are out of our control that make our forecasts unreliable. We could go into recessions, there could be global conflicts. And as we said, just because we identify that there's a cash flow problem does not guarantee it will be solved. It can also be quite time consuming to create these cash flow forecasts and to maintain them. Typically, a business will want to try and look at 12 months into the future. Anything ahead of those 12 months, that's when the cash flow forecast, the accuracy may not be that good because a lot of stuff can change within the next year. And finally, in order for you to be able to produce that cash flow forecast, you need a lot of expertise in doing it. So if you're a first time business owner, you've had no experience making one, there's a good chance that the forecast you make won't be that accurate. If you found this video useful and want to continue your revision in these financial topics, then I highly recommend you check out our video here on income statements. I hope this video has helped you with your revision about cash flow and cash flow forecasts. Thank you so much for watching, and I'll see you in the next one.